All right, welcome everyone. Welcome once again to this class. Now we have come into the second part of this training, which is the trading part. All right. All this while I've been exposing you to the fundamentals of crypto and blockchain. I've been exposing you to the DeFi platforms. I've exposed you to the activities. You see all those activities that take place in the bank. That is the DeFi platform, and I've exposed you to a lot the aggregators and a lot of platforms you can use to get information about tokens, what to check out before buying a coin, and or what to check out before selling a coin. You've seen that, you've known that, and now we are going into how to trade itself. Now, trading the crypto. Now, this is just one part of trading cryptocurrency. I told you that earlier, one of our classes, I told you that what you need to be a good trader is 80% your psychology and 20% your trading skills and strategy. 80% your psychology, 20% trading skill and psychology and strategy. So, and we've been dealing with a lot of things that has to do with your psychology. I am still going to treat something about psychology before the end of this session, remaining sessions, right? But today I'm going to introduce you to chart patterns. I'm going to introduce you to chart patterns. If you check our what we have in today, it's chart patterns and chart setup. So, and I'm going to use the Candlestick Trading Bible by Monesiha Huma. Now, this is a man who is good with trading. He was, according to history, the most successful trader in history. So this is going to show you what the candles, what they represent. You know what this candle is. Now, the candles are this thing. I hope you're seeing my cursor. Candles are the green ones and the red ones. That is what we call candles. All right. Now, each one of them represents something. The way the short, the long, the full and the thin, they all represent something. And when you get to master them, you would be a better trader. Now, candlestick trading, trading with candlestick is usually what we call price action trading. All right. So we are going to go into that. So we are actually going to review this book. I'm going to pick the most important ones. It's not everything that I'm going to treat, but you already have the book, so you can take your time, go back to it and treat it. Okay. All right. So let's just go ahead. Now, we have candlestick patterns. We have candlestick patterns. We have market structure. We have candlestick patterns and market structure. So we are going to first go into this thing. Introduction. Do I need to do an introduction again? No need. Now, let's go to the overview, the candlestick anatomy. As humans, candlesticks have different body sizes. And when it comes to trading, it's important to check out the body size, the bodies of candlesticks, and understand the psychology. Now, every candlestick, there is a psychology behind it. There's a psychology that goes with it. So both the small, the big, the thin, the large, they all have a psychology. That is why we also have the psychology of a trader. I'm also going to send you a document I prepared on the psychology of trading. So, all right. So it's what you will learn in this section. Candlestick patterns. Candlestick patterns are an integral part of technical analysis. So where we are treating now, we have entered into technical analysis. What we are doing now is technical analysis. It is an integral part of technical analysis. It emerged because human actions and reactions are patterned and constantly repetitive. Now, the reason why we have candlestick analysis is because there is nothing that is happening in the market now that has not happened before. So because human actions are repetitive, we experts were able to come up with these kind of patterns, candlesticks, to represent human behavior. And because they can represent human behavior, you can predict more accurately. Trading is prediction. I repeat, trading is prediction. But in this prediction, you are able to predict more accurately because there are tools that helps you to do those predictions. It is not like football prediction or betting, where you are betting based on emotions, based on what you feel. When you're dealing with technical analysis, remove your emotion from it. That is why I had to first talk to you about your emotion, your psychology as a trader. I've treated that, right? So when you're dealing with your emotion, or when you're dealing with technical analysis, you have to remove your emotion because technical analysis does not respect emotion. So because over time, these technical jargons are representing emotions by themselves. They are representing behaviors already. So you cannot use your own behavior now and influence the market. The analysis will always stand. So human actions and reactions are patterned and constantly repeated. So you will learn how to recognize the most important candlestick patterns, the psychology behind its formation, and what they do, and what they indicate when they form in the market. That is one of the things you're going to learn. The market structure. In this section, you will learn how to identify trending markets, ranging market, and choppy markets. Already, you have 3 types of markets. You should know that. We have the trending market, we have the choppy market, choppy market, and we have the ranging market. So I will show you how to identify these markets. And you will learn how this market move and how to trade them. So you also learn how to draw support and resistance and trend line. If you go back to the Zoom link, these are the things I listed out for you that you're going to learn in this session. Time frame and top-down analysis. Multiple time frame analysis is very important for you as a price action trader. Now, you see why you said here, price action trader. That is a candlestick trader. There are people who trade only with candlestick. They trade price action. They use candlestick and they manipulate, they get what they want in the market. In this section, you will learn how to analyze the market using the top-down analysis approach. Trading strategies and tactics. In this session, you will learn how to trade the market using 4 price action strategies, the pin bar strategy. I'm not going to go into these ones. But I have my own strategy. I don't use pin bar strategy. I don't use engulfing bar. I don't use any of this strategy here. I have my own strategy. So I am going to focus on the candlestick patterns, the anatomy, the market structure. By the time you understand this and you understand these 3 things, you will be able to create your own strategy. All right? You can as well go into reading the pin bar and understanding those strategies for yourself. Okay. All right, let's go on. Money management. In this section, you will learn how to create money management and risk control plan that will allow you. That's why I mentioned psychology of trading. That is money management and also risk management. All right, you're also going to learn that portfolio control. Now let's go into the candlestick history. Now, the candlestick has been around a long time. The Japanese were looking at charts for far back as 17th century, whereas the earliest known chart in the US appeared in the 19th century. Rice trading has been established in Japan in 1654 with gold, silver, and rapeseed oil following soon after. So it just giving you a history of how the candlestick was formed and all that. So Homer, a Japanese rice trader born in the early 1700s, is widely credited as being one of the earliest exponents of tracking price action. He understood basic supply and demand dynamics, but also identified the fact that emotion played a part in the setting of price. He wanted to track the emotion of the market players, and this work became the basis of candlestick analysis. He was extremely well respected to the point of being promoted to samurai status, and you know what samurai status is in Japan. The Japanese did an extremely good job for keeping candlestick quiet from the Western world right up till or until the 1980s, when suddenly there was large cross-pollination of banks and financial institutions across the world. This is when Westerners suddenly got a wind of this mystical chart. I think we can read up these ones later. I just want to go into the main topic right away. We have virtually 1 hour left. Why candlesticks are important to your trading analysis? Candlesticks are important to your trading analysis because it is considered as a visual representation of what is going on in the market. You see why it's important. By looking at candlestick, you can get valuable information about the open, the high, the low, and the close of the price, which will give us an idea about the price movement. Candlesticks are flexible. They can be used alone or in combination with technical analysis tools, such as the moving averages and momentum oscillators. They can be used also with methods such as Dow theory or the Elliott wave theory. Now, he said, I personally use candlestick with support and resistance, which I do, trend lines and other technical tools that you will discover in the next chapters. The human behavior in relationship to money is also predominated by fear, greed, and hope. I talked about fear and greed before. He said fear, greed, and hope. Candlestick analysis will help us understand these changing psychological factors by showing out how buyers and sellers interact with each other. Candlesticks provide more valuable information than bar charts. Using them is a win-win situation because you can get all the trading signals that bar charts generate with the added clarity and additional signal generated by candlestick. Candlesticks are used by most professional traders, banks, and hedge funds. These guys trade millions of dollars every day. They can move the market whenever they want. Did you hear that? There are people that move the market, not be you. Your $6, your $10, your $20, your $100, your $500, your $1,000 cannot move the market. Your $5,000 cannot move the market. Your $10,000 cannot move the market. Your $50,000 cannot move the market. What moves the market is millions of dollars that all these professional traders use on a daily basis. So see, one person will be using $500 million to trade. You and I'm not be mates. So you don't go, that is why I said you don't trade against the trend. You flow with the trend. Because these are the people that decide the trend of the market. They can take your money. Now look at it, listen again. Candlesticks are used by most professional traders, banks, and hedge funds. These guys trade millions of dollars every day. They can move the market whenever they want. They can take your money easily if you don't understand the game. Even if you can trade $100,000 trading account, you can't move the market. You can't control what is going in the market. Let it sink. This one is a dangerous aspect because this thing can make you go back to the village. I am not joking. You can see the intensity of my voice. This trading not only crypto space, whether crypto, because the moment you learn candlestick trading, you can trade any market. This can take you to the village. It can wipe away that your 100,000 naira in your account. and it can give you money. That is why I first had to expose you to the safer part of the crypto space, which is DeFi. All right, let's go on. Using candlestick, please, at any point, if you have a question, drop it at the comment section. Using candlestick pattern will help you understand what the big boys are doing, and we show you when to enter, when to exit, and when to stay away from the market. I have mentioned three types of markets already. Put it at the comment section, the types of market I mentioned. Put it at the comment section. I mentioned 3 types of markets here already. Drop it at the comment section. Let me know you're following. I'm waiting. Let me see it at the comment section. If you don't know, just drop I don't know. If you did not get it, drop I did not get it. Let me know you're following. I've been in class since 7 a.m. Please, since 7 p.m. You need to make me feel good.
We have the uptrend, the downtrend, and the
Please mute your mic. Mute your mic. Just use the comment section. Don't worry. Divine said trending, ranging, and choppy market. Good. I didn't get it. Have network issues. That is who? Prime. Prime is in the comment section now. You can see trending market, ranging market, choppy market. Good. So Prime, you can see it. Others, you can see trending market, ranging market, choppy market. Good. You are following. You're following. All right, let's go on. What is a candlestick? The Japanese candlesticks are formed using the open, the high, the low, and the close of the chosen time frame. So for you to actually read a candlestick very well, you need to know the time frame you are reading that candlestick from. So note that. Now, this thing I'm explaining to you, I'm not getting a note from anywhere else. So anything I am telling you now, you need to note it put it down in your own notes, because these are things that are coming from the inside of me. I did not prepare any special notes for this class. No. So you need to make sure that you're putting these points down. There are some points I'm noting here that are not in this book. Put them down. So now look at how a candlestick looks like. This is the upper shadow. The upper shadow is this part where you're seeing my cursor. This is the upper shadow. This is the lower shadow. This is the body of the candlestick. Now, it's either it's white or black, or it is green or red. The colors you will use to cover the colors the body of a candlestick carries. So now the high is this level. At this level, the highest level it got to be. Now it means that from this level to this level, that the buyers pushed the market to this point, and the sellers now brought it back to this point. So the high is where the highest point at which the buying power got to. The low is where the sellers pushed the market to, and the buyers began to push it back up till it got to this point. That is the low. So this low is where the market dumped to before it began to go up. The open is when the market began. When the market began, we have different. We have market. We have the UK market. We usually, when you are in trading, you will see, you hear when the Chinese are awake, when the UK market is awake, when this one is up. Now, the open is when this market began, when this particular trading psychology and behavior began. That is the open. The close is when this particular trading behavior stopped, ended, and another one began. That is the close. So it's the same thing happening here that is happening here. The difference is that this one is a black body, this one is a white body. All right? Okay. We'll go on. Now, look at these points. If you really want to do well in trading, make sure you study this book tentatively. If the close is above the open, we can say that the candlestick is bullish, which means that the market is rising in this period of time. Bullish candlesticks are always displayed as white candlesticks. Now, if your color, the color you choose, white means bullish, green and black means bearish. So if you come to a green and red, green means bullish, red means bearish. Let's go back to here. Sorry. Remember here, look at red, look at green. Green means bullish, red means bearish. White here means bullish, black means bearish. So don't get confused about it. In doing this, let me open something else. Let me open, also have open trading view. Now drop in your WhatsApp group assignment number 1. Create a trading view account. Trading view. You go to Play Store, download trading view. Create a trading view account. I want somebody to drop it as an assignment. Assignment 1, create a trading view account. Go to Play Store, download trading view. I want to see it there. Somebody is writing it. Okay, Ndibe is writing it. Create a trading view account. Let me open my trading view now. I have the account already. That's good. Okay, if you have the account, that's good. For those that don't have the account yet, go and create the account. Trading view. Trading view. Okay, I have trading view on my PC. But if I open that, and I hope it will not affect this thing. Okay, while we are waiting for that to open, let's go back. Let's go back. AI, leave me alone, I beg. Okay, with that taken, let's go back. Now I made mention of something. The first thing I said was that candlesticks, we are talking about candlestick. If the close is above the open, if the close is above the open. Now, if the close is here, we can say that the candlestick is bullish, which means that the market is rising in this period of time. My trading view is not responding. Let me open it here. Trading view. Please move this window away from the shared application. What did I do here now? Let me stop sharing. I'm going to share my screen now. Okay. This is my trading view. Hope you can see my trading view screen. You can use the comment section. Okay. Now this is my trading view. I believe you have your trading view now if you have downloaded it. Now on the system, this is how it shows. So it's a bit more defined on the system. It's easy to operate with on the system. The same thing on the phone, but you know the system will give you more, will give it more space for you to see all its inside. Now you create your account on TradingView and then you do your setting. And so the first thing you do is to go to launch super chat. I just want to go there because I'm not actually treating TradingView tonight. Launch super chat. So I'm going to just click on launch super chat. I'm going to click on launch super chat. So now this is TradingView in TradingView in a jiffy. So it will show you, with this you can begin to make your decisions, begin to see what the market is like and all that. You decide your time frame and all that. So now this is what I wanted to show you. You see the candles, the red ones, you see that the red ones are the ones that are going down. You can change the color of the candle in your setting. Change it to white and black. Of course, you can change it to any color of your choice as long as you would know what they stand for, right? If you notice, the red ones are the ones going down, are bearish. The green ones are bullish. So that is what the book was that we were reading in the book. That is what we were reading in the book. So let's go back to the book. Okay, so you have seen
Yes,
what
ma'am.
trading view looks like, right? So we go on. I've mentioned some things to you tonight. I've shown you the body, what the body is like. Now, the second part, it said the most trading platform use white color to refer to bullish candlesticks. But the color doesn't matter. You can use whatever color you want. The most important is the open price and the close price. The open price is the close and the open. The open and close. Now look at it. Here is close and open, meaning that the market started from here and closed here, meaning it is an upward movement. But here is open and close, meaning that the market started from here and closed here, and it is a downward movement. And I told you the white body represents bullish, that is green body. The black body represents bearish, that is red body. I hope you grab that one. So it's that easy. It is very easy for you to understand. So the most important part is the open price and the close price. If the close is above the open, we can say that the candlestick is bearish, which indicates that the market is falling in this session. Bearish candles are always displayed as black candlesticks, or can someone say the next color? Black candlesticks, or what color?
Red color.
Thank you. Or red color candlesticks. But this is not a rule, of course. You can use whatever color you choose. All right. You can find different colors, use them. The filled part of the candlestick is called the real body, which is here. This is the real body of the candlestick. This is the real body. Now, this is giving you an information already. When I opened this place, now, this is a real body. I hope you can see my screen. This is a real body. Now, this body and this body are not the same. This body here and this body here are not the same. Even though they are red, this one and this one are not the same. This one and this one are not the same. You see? So they are all telling different stories and also different behavior of the market. Now look at this one now, this red one, this last red one. Look at where it opened. Look at where it opened. Look at the low. Look at the high. Look at the open. I mean, look at the open. Look at the close. That tells you it's a bearish market.
No, we can't see it.
Oh, you cannot see my screen? What you're
Yes,
seeing
ma'am.
is the book. Oh, okay, you are still seeing
Yes,
the
ma'am.
book.
Yes,
Oh, my apologies. This was what I was trying to show you. Okay, let me share my entire screen then. I think it's better so that whichever one I go into, you can see. Can you see this one? Are you seeing my picture? Okay. Now, this is, at this point, this is the open. This point now is the open. This point is the close. This is the low. This is the high that I was showing you earlier. This point is the high. This is the low. This is the close. This is the open. Now, why do I know how do I know the close and the open? This is a green candle. It's a bullish candle. When the markets began from here, which is open market, and then it closed here at a very profitable point for buyers. But here now, The sellers began to fight the buyers and drag the market down. So the market opened here. It started here, but closed here. So for the sellers brought it down, and therefore it was a loss for the buyers. That is why it is carrying a red color. But here now, the buyers began to push. That means this market here came down, actually went down. Press hold on. Why is zooming to maintain the chart position? Okay. This market came down to this point, but buyers continued pushing it until it is here. This is the current price. You see, it's going up and down. Now, if you take your time frame, take it to 5 minutes, you will see more movement. You see, this place now went this bad. The market went this down, but it kept pushing up until the buyers took over the market. At this point, the sellers are trying to push buyers down, but buyers are still in charge, right? Now, that's what makes crypto market different from forex market, because crypto market is a 24/7 market. It does not close. We don't have a stop. There is no time of stopping in the crypto market. It is a 24-hour market. You can always trade it. You can always trade the crypto market. I'm in class. Drop a message, I'm in class. Okay. So that is that. I hope that explanation sufficed. I hope you got that explanation. This my screen. It is well with me, and this my screen. So this class will end by 11 p.m. Oh my God, what is it with my screen? All right, I'm still trying to share the book that we are reviewing. Okay. I think this fault is from my end. Okay, you can see the book now, right? Let's go on. So you understand this now. It said the upper and lower shadows give us important information about the trading session. Upper shadow signify the session high. Lower shadow signify the session low. I've explained that one earlier, right? Candlestick with long shadows show that trading action occurred well past the open and close. Do you understand this statement? You can unmute and answer. Do you understand this statement? I hope this thing is on record.
No.
Okay, this means that this is an upper shadow. This is a long upper shadow. The shadow is this line up. You're seeing my screen, right? This line up is the shadow. Now, it says that candlestick with long shadows show that trading action took place well after the open and the close. Now look at the open. Remember, okay, I think I went farther than where I was. This was where I was, right? Okay, let's go back. If the close is below the open, we can say that the market is bearish, which indicates that the market is falling in session. Bearish candles are always displayed as black candles, but this is not a rule. So I explained this earlier. The filled part of the candle is called the real body. The thin lines poking above and below the body are called shadows, which is this. This is a shadow. This line now is a shadow. This line is a shadow. This one is a shadow. This one is a shadow. This is a real body. So now he said the top of the upper shadow is the high. The bottom of the lower shadow is the low. This is a low. And what is here called? You can unmute and speak. What is here called?
Upper shadow. High.
A high. Good. It's a high. So now candlesticks have different body sizes. Good. We have this size, we have this size, we have this size, we have this size. The long bodies refer to strong buying or selling pressure. So this thing now, as you're seeing it very thick and long, it means that the sellers are more than buyers, that the sellers are much. The selling pressure is high. It shows you that the market is a selling market. Now, here now shows you that the market is what? What is the pressure here?
Buying market.
Good. The market is a buying market. The buyers are much. Okay. If there is a candlestick in which the close is above the open with a long body, this indicates that buyers are stronger and they are taking control of the market during this period of time. You see, it kept using that word, period of time, because the time frame matters. What happened in this time frame may not happen in the next time frame. So the period of time is important. Conversely, if there is a bearish candlestick in which the open, where is the open again? The open is here. Remember, now here is the open of this market because it's what? What market is this again? This market, what market is it?
Selling bearish market.
Good, a selling or bearish market. Because it is a bearish market, where is the open? Here or here? Up or down?
Up.
Good. The up is the open of the market and the market closed down. So he now said here, if a bearish candle is in which the open is above the close with a long body, this means that the selling pressure controls the market during the chosen time frame. So the short and the small body indicate little buying or selling activity. So this tells you that there is little selling activity. So let's check it. Let's check it if what they are saying is actually true. Can you see this part of the screen? You're still seeing the book.
Yes.
Yes, ma'am.
Book.
Okay. Let me reshare again. If I'm sharing the entire screen, I don't know why it's not coming up, the entire screen. I'm sharing the entire screen. It's supposed to show everything, right? Now you're seeing this market, right?
Yes, ma'am.
Good. Now, this is under what? What's the time frame here? 5 minutes. Let's go to 1 hour. Let's go to 4 hours. This is a 4-hour market. What does this tell you? Looking at this alone, what does it tell you?
There is a bearish market.
You can raise your hand and speak so that we can hear each other. Raise your hand and speak. What does this market tell you? Is it a bearish market or a bullish market? A bearish market.
A bearish market.
Ezekiel, is it a bearish or bullish market?
It's a bearish market.
Okay. Is this a trend market or a chubby market? or a ranging market? Ayo.
Chubby market.
It's a chubby market. Okay. Divine, is it a chubby market, bullish market, I mean trending market, or a ranging market? Which one is it? Divine.
I didn't get the trading or the choppy side aspect of this.
So why didn't you ask a question when I was treating it? So, who else is in this class? Who hasn't spoken?
It's a chubby market, man.
Okay. It's a chubby market.
Yeah. Starting from that.
Starting from here.
Yes, ma'am.
It's a chubby market. Mr. Livinus, is it a chubby market, trending market, or a ranging market? Mr. Livinus is still eating his food. He's not with us. Okay. The ladies, no lady is here. None of the ladies attended class today. Amazing. All right. This market.
Sorry. Can I ask a question?
Yes. Don't go further than what we are treating now.
Okay, forget it. Okay, continue.
This market, you say it's a chubby market under 4-hour time frame. Let's find out if it's a chubby market. Under 1-day time frame. Under 1-day time frame. So can you call this a chubby market? Under 4 hours. Let's see. Is this a chubby market?
Yes.
Really?
Yes.
What makes you say so?
Because from that point now, from that point, the pull back, but sellers are in control of the market.
It is not a chubby market. It's not a chubby market. It's a trending market. You have trends. It's hitting trends already. Yeah. There's a trend here.
Which is a downtrend now. That's what I'm trying to say, downtrend.
No, that whether it's a chubby market is not a downtrend market.
Okay.
A trending market is a downtrend or an uptrend, a clear downtrend or a clear downtrend market. A chubby market is a market that has no particular direction. A ranging market is a market that is almost at the same range. Say, for instance, inside this trendy market now, there is a ranging market. Let's go to 15 minutes time frame. Inside this chubby, trendy market now, if you go to 15 minutes time frame, go to 15-minute time frame, which is here. Between here and here, between this point, between this point and this point, is there a clear market there? Yes, even that point is even clearer. You look for a ranging market. This is a ranging market here. between here and here is a ranging market. In fact, here and here. Are you with me?
Yes, I'm with you.
This is a ranging market. It is almost at the same range. So you cannot, a good trader will not trade between these points. Let's not go farther than we are. All right, let's go back to our book and see what it says. It will explain the chubby and the ranging market. Don't worry, we'll get there. We'll get to that point. You will know the difference. All right.
Okay.
So here we are now. Let's go back to our book. Now it says that you now know the difference between the long body and the short body. Abi, let's go on. Candlestick shadows, details. I explained it earlier. We have 30 minutes to round up this class. The upper and lower shadow gives us important information about trading sessions. Upper shadow signifies session high. Lower shadow signifies session low. Candles with long shadow show that trading action occur well past the open and the close. So when you saw that long one, there are actions that were taken from here till even after here till here, but the market closed here. The market opened here, went down, and started coming up again, went up past the open, continued, came here, went up, and seller pushed it down to this point and it closed. That is what it means. This line now shows that is the upper shadow. It signifies that the market actually got to this point and came down to this point and closed. This point now means the market got to the point but came down to this point. The market opened here, went down, came up and continued. The market opened here. The market opened here. And it came up and continued, went up, and the sellers brought it back low. And it closed lower than where it opened. So it was a losing market for buyers. So I hope you understood that. Now, Japanese candlesticks with short shadow indicate that the most of the trading action was confined near the open and close. That is what I explained here. Please mute your mic. If a candlestick has a longer upper shadow and short lower shadow, this means that buyers flex their muscles and bid price higher. If a candlestick has a longer upper shadow, which is here, the buyers were pushing it up, but the sellers won the case. Same thing, but for one reason or another, the sellers came and drove the price back down to end the session back near its open, which is here. If a Japanese candlestick has a long lower shadow and short upper shadow, this means that sellers flashed their washboard apps and forced price lower. It means that here now, the sellers pushed the price to this point, but the buyers pushed it back to this point. And it closed above its open, where the market opened. So it's on an uptrend. The candlestick patterns are one of the most powerful trading concepts. They are simple, easy to identify, and very profitable setup. A research has confirmed that candlestick patterns have high predictive value and can produce positive results. He said it, blah, 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 blah. Personally trade candlesticks, blah, blah, blah. I'm not going to introduce you to a holy grail. This trading system works, but be prepared to lose some trades. Losing is a part of this game. If you're looking for a 100% winning system, I highly recommend you stop trading and go look for another business. Did you hear that? Candlestick patterns are the language of the market. Imagine you are living in a foreign country and you don't speak the language. How could you live if you even say a word? Blah, blah, blah. If you know how to read candlestick patterns the right way, you will be able to understand what this pattern tells you about the market dynamics and the trader's behavior. This skill in other words, this skill will help you better enter and exit the market in the right time. In other words, this will help you act differently in the market and make money following smart guys' footprint. The candlestick pattern that I'm going to show you here are the most important patterns that you will find in the market. I'm going to show you how to trade them because this will be explained in details. What I want you to do is to focus on the anatomy of the pattern and the psychology behind this formation, because this will help you get the skill of identifying easily any pattern you find in the market and understand what it tells you to do next. If you can get this skill, you will be ready to understand and master the trading strategies and tactics that I'm going to teach you in the next chapter. Okay, so now we are entering the candlesticks itself. We have 20 minutes to go and I will ramp up. So let me introduce you to the first two candlesticks for the evening. The first one is the engulfing bar candle pattern. It is a candlestick and a candle pattern. The engulfing bar, as it states in its title, is formed when it fully engulfs the previous candle. When a candle fully engulfs the previous candle, that is an engulfing bar. The engulfing bar can engulf more than one previous candle, but to be considered an engulfing bar, at least one candle must be fully consumed. There are two types of engulfing candle. That is why it is a pattern. The bearish engulfing bar, engulfing candle, which is the most important candle pattern. It said this pattern, this candlestick pattern consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. Now look at it here. Are you guys seeing it? This is an engulfing what? Engulfing bar. This is an engulfing what? Engulfing bar. This is the opening price where the market began and closed here. And look at it. There's no line down. The small bar, this is a bullish bar. The market was rising. The market was rising. And it closed at a profitable price for the buyers. But now the sellers began to bring the market down, bring it down, bring it down, bring it down to this point. Then when they brought it down to this point, already the bringing down started from here. So the market opened here and closed here. So it's a bearish candle. Now, because this candle closed, why it is called engulfing is because it covered this bullish candle totally. So it is called a bearish engulfing bar candle. So it's a pattern of trading. So you can identify it in the market. So let's say we go back here and look for a bearish engulfing. Let's go here and look for a bearish engulfing. Let's see if we are going to see a bearish engulfing bar. Can you see my screen?
No, ma.
Okay, I'm coming. But you can see this, okay. Okay, I have to stop it and share again. So you can identify a bearish engulfing bar, right? So let's go. Let's check for a bearish engulfing bar. What are the two candles in a bearish engulfing bar? The first candle is what? Speak up, guys. Speak up.
Bullish.
The bullish candle. The bullish candle, is it big or small?
The
Small.
small one.
Good. The second one is what?
Bearish.
Bearish and
Bearish.
big, right? So let's begin to, this is AA Arbitrum USDT perpetual contract. This is Arbitrum USDT. So this under 15 minutes. Let's take it to 4 hours and see if we are going to see a bearish engulfing bar. Now, it doesn't mean that every market will have a bearish engulfing bar, but let's see. If you see it first before me, you can let me know. A bearish engulfing bar. A bearish engulfing bar. A bearish engulfing bar. The bullish one comes first before the bearish one, right?
Is there now? See it.
Here?
I've seen it, man. No. Okay, that one too, but not the one I saw.
Yeah.
Go back. Go back.
This one.
Divine, what did you say?
The one before that long one.
Divine, what you need to use the date, Wednesday 27th. Use that date to let me know when.
Okay.
It's in between 23 and 24.
In between 23,
22 and 23, sorry.
22 and 23. Okay, between here and here. Is it this?
Yeah.
This is not a bearish engulfing.
This and the other.
This, is it
Not
this?
that one.
This
No, ma,
one?
between 22, ma.
Yeah,
22.
that one and the other one at the back.
You're reading backwards now.
Say 24. 24.
24. 24 is here and here. Wow.
No.
Which one?
Between 23 and 24. Between 23 and 24.
23.
That red card. This one.
Yes.
Yeah, that one.
Bearish
That two now.
engulfing. Good.
That
Bearish engulfing. Now let's look at it. Let's look at it. Look at the low. Look at where the wick stopped. That's the low. So did it cover it? This one covered it and came down. That's interesting. And it covered up. So it actually engulfed this one. So this is a bearish engulfing. Interesting. Interesting. Under a 4-hour time frame is a bearish engulfing. And since when it happened, what happened? The market began to go down. And it's been going down ever since. Are you seeing it? So this alone is a signal. Are you following, guys?
Yes.
This alone is a signal, but that does not mean you should trade it alone. Because even in trading it, this market now came up at a point to this point and still went down again. So you need to know the strength of this bearish engulfing. So let's go back. Now you have identified the bearish engulfing. That is interesting. How interesting is the class now? So now you have seen a bearish engulfing. He said, this is how a bearish engulfing bar pattern looks like on your chart. This candlestick gives us a valuable information about bulls and bears in the market. He said, in the case of a bearish engulfing bar, this pattern tells us that sellers are in control of the market. Did you see that bearish engulfing happened at the high point, at the bullish point in the market where people were thinking everything was bullish? It started going down, meaning the seller started taking control. When this pattern occurs at the end of an uptrend, you see it, that place it happened was an uptrend. This indicates that the buyers are engulfed by sellers, which signals a trend reversal. It signals a trend reversal. Now look at what happened that point. This one now, it happened there and it was a trend reversal. Let's go back. Let's go back to that bearish engulfing. Let's go back. Oh, okay. Let's go back and see it. Now, look at this. Shay, this is what you said happened. This is the bearish engulfing. This is an uptrend. This thing has been, remember, it's a 4 hours time frame. Now, when you see a 4-hour time frame, you are looking at 8 to 24 hours trading. Imagine if you enter a trade at 4-hour time frame, you're looking at trading that, being in that trade for between 8 to 24 hours. You could be in that trade before it would trigger between 8 to 24 hours. Now, look at it for over almost 24 hours. This market was up, very bullish. People were excited, selling and buying. People were buying, I mean, seriously buying. Everything was pumping. It began to retrace, came down here and pumped again. It went up. And then at this point, what happened? The bearish engulfing candle happened. The moment it happened, there was a confirmation of another red candle. So this candle was a confirmation to this one that this is a bearish engulfing candle. The moment it happened, the market began to go down. Since then, the market has not recovered from going down. Look at it. Till this point, till as we speak, the market has not recovered from that move. It's still on a downtrend. It has not broken the resistance. It's still on a downtrend. Look at it. Are you seeing it? This is now, this candle confirmed that this is a bearish engulfing bar. And think, so with this now, you can enter a sell trade. You can enter a sell. You can short. Yes, Chigovie.
The confirmation candle you are talking about now is the second bearish candle before
yes.
the
yes, this one now. You can see this one now. That is the confirmation candle.
Confirmation for the entry. Okay,
yes.
No problem.
That's the confirmation candle under 4 hours. So let's look at
Under
this.
4 hours.
Let's look at this particular trade now, bearish engulfing candle in under 1 hour. You see where it is there, under 1 hour. This was where it happened. This is where the trade happened. You see, at this point, under 1 hour, look at what took place here. Under 1 hour, it was not a bearish engulfing. Are you seeing it? But under 4 hours, this point, because this is the whole of this place now is under the 4 hour. Between here and here is under the 4 hour. Look at it, under 1 hour, under 4 hours. This is a bearish engulfing. A very clear entrance for a sell. Are you seeing it? So you need to know, you need to see this sign, and also allow confirmation of the candle before you enter the market. So let's go on. Let's not spend too much time. So you see it. This is the kind of trade that somebody will enter and then stay for days because there is a confirmation. Now, he said, as you can see, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because buyers are not still in control of the market and sellers are trying to push the market to go down. You can't trade any bearish candle pattern you find on your chart. You will need other technical tools to confirm your entries. So you cannot trade this alone. This kind of pattern now, you cannot trade it alone. You need to get confirmation before you trade. This is a confirmation, but let's still go ahead. There are other confirmations. We will talk about this in details. Right now, you just need to identify which we have done, right? Then the next candle is the bullish engulfing bar. which consists of two candlesticks, just the opposite of what we did, bullish engulfing. The first one is the small body, and the second one is the engulfing candle. Now look at it. It's just the opposite. The other one, this was the bullish candle, right? And the long bearish candle. But this one, the bearish candle is small, and the long candle is the bullish candle, right? So let's go and identify it. Let's identify it. Let's look for a bullish engulfing bar. A bullish engulfing bar. If you see any bullish engulfing bar, let me know. Under 4 hours. If you see any bullish engulfing bar, let me know. Anyone here? Are we still here? Are you two with me?
Yes,
Have you
I'm with
seen
you.
anyone?
Yeah, this one here.
This one?
Yes, ma'am.
Yes.
That's the bullish engulfing. Okay. Any other one?
Still checking.
Yeah, yes, ma'am.
Which one?
The one here, I think.
Use this either 20 or 21 or 16. Use the time. Which one? Here?
20 to 20 to 20
Is it,
to 20. Is that 20 again?
No. This is not
is it
engulfing.
is it this one?
No.
Okay. Let's go on. Make sure you're following. Bullish engulfing. The bullish engulfing is what candle and what candle?
The red before the green.
The red candle, is this small or big?
Small.
The small one.
So the green candle will engulf. That means the green candle swallows the red candle, right?
Yes.
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 Okay. So let's go on. Have you seen anyone?
No.
Mm,
Bullish engulfing. Okay, let's use 1 day time frame. This is under a day time frame. Every candle here, one candle represents a whole day. Each candle represents 1 day. That's what it means. Any bullish engulfing here?
No.
What about this one?
Which one?
Okay.
It still went down.
Any bullish engulfing here?
ma,
What about this one? Is it not a bullish engulfing?
yes.
Yes, I
Is
think.
it
Chigozie,
What about this one? Between 6 and 11.
between 6 and 11.
The red one, green one there.
No, you're reading you're reading this way. The green one has
I
to
think it's
engulf the red one. Mr. Livinus, the green one, the red one now, if the red one is smaller and it is engulfed by the green one, that is bullish engulfing. Except you're talking about this one.
Look at this red in between 6 and 11.
My,
We have green, red, and green. Then
That
in
is what
between, there's
this,
big.
this
my
one
stop.
and this one. Hold on, Divine. Hold on. Mr. Livinus, is it this one and this one?
In between. If you go to 6 now, you have.
This one. Is it not this one my cursor is touching? Or is it this
No,
one?
you are.
Okay, 6 and 11. This is 6 and is it March, 6 and 11 March, or 6 and 11 February? Or 6 and 11 April? April. Okay, April.
Yeah.
This one. Good. This is a very good example of bullish engulfing. Look at it. Both the low and the high are covering the low and the high of this one. This one now is a bullish engulfing. So let's stress it. From that point, and it happened at the bottom side of the trend.
Yes.
The trend was coming down. It happened at the bottom side of the trend. And what happened? The trend began to pick up and jumped up. Are you seeing it?
Yes, ma'am.
Before it started going down again. This one took place here, and this is a good bullish engulfing, because now the low covered the low of this one. Everything about this candle was engulfed by this green candle. So that is a good bullish engulfing. I hope we picked that.
Yes,
and
ma'am.
it changed automatically. It changed the trend of the market. I hope that was understood.
Yeah.
So let's go back to our book and then wrap this one up for this evening. Now, he said here, the bullish engulfing bar pattern tells us that the market is no longer under control of sellers, and buyers will take control of the market. When a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation signal. I hope you grab this on this. You see that place that I showed you now, that the bullish engulfing candle happened in the downtrend, in the downside of the trend, right? And now it changed the trend to go up. The market began to go up. If that particular bullish engulfing happened at the uptrend, it simply means that the market will continue going up if it was an uptrend. When a bullish engulfing bar forms at the end of a downtrend, the reversal is much more powerful as it represents a capitulation bottom. See example below. Now, look at that thing I told you. Now, this bullish engulfing happened here, and the next thing, the market began to pump up. You saw how that one did. There was a massive pump. Those two long green candles that took place before it began to go down. I hope you understand that.
Can I ask?
Yes, ask a question.
Can I ask?
Yes.
After this engulfing now, most times, due to maybe now traders might be waiting for a confirmation before entry. What of maybe now after the engulfing now, the thing now shows a bearish candle? What do you suggest to do?
That is why initially he told us here that you don't trade don't trade the engulfing candle alone. Look at it here. You don't trade the engulfing candle alone. He said, where is that place he wrote it down? He said you don't trade the engulfing candle alone. It must be confirmed with other this thing for you to trade it. It's not something you just enter the market alone. He said, I don't, you remember when I mentioned that the bullish engulfing candle is,
I think you passed it.
eh?
You passed it, man.
Okay, I've passed it.
Can't trade any.
Good. You can't trade any bearish candlestick pattern you find on your chart. you need other technical tools to confirm your entries. So it's not just because you saw the engulfing candle you can enter, except you want to double in. You don't trade it alone. You need to still confirm it with other technical tools. So that is this about the bearish and the bullish engulfing candles. So now look at, example shows us clearly how the market changes direction after the formation of a bullish engulfing bar. So you see, the market begins to go up when that happened. The smaller body that represents the selling power was covered by the second body that represents the buying power. The color of the bodies is not important. What's important is that the smaller one is totally engulfed by the second one. Don't try to trade the market using this price action setup alone, because you will need other factors of confluence to decide whether the pattern is worth trading or not, which we will talk about later. He said, I want you to now go identify the skills. So the second assignment I'm giving you, go and identify in a chart. You will have to screenshot it, note it, and send to me. In a chart, identify the bearish engulfing candles and the bullish engulfing candles on Bitcoin. Bitcoin under 4-hour chart and 1-day chart, 1-day time frame and 4-hour time frame. Identify the bearish engulfing candle. When you see the bearish engulfing candle, you circle it and write there. And you use black color for bearish engulfing candle, and use white color. That thing you're using to identify, that's the color you're using to round it. You know what I mean? Use black for bearish engulfing candle and use white for bullish engulfing candle. So identify 5 bearish engulfing candles under 4-hour time frame and 1-day daily time frame on Bitcoin. 5 different bearish and bullish engulfing candles. Submit this before the next class, which is tomorrow evening. So this assignment, you must submit it before 3 p.m. So this is what I am leaving you with tonight. Firstly, there are 2 things I've given to you, 2 assignments, right? Create a TradingView account, download it, create it, and then identify 5 bearish engulfing candle on Bitcoin and 5 bullish engulfing candle on Bitcoin under 4-hour time frame and daily time frame. That is your assignment for tonight. All right. Any question?
Can you show us? On this TradingView now, we have both. This TradingView now consists of so many things, both the stock exchange and everything. Can you show us where to go? We'll see everything that has to do with crypto, so that we won't get confused as first time, so that we'll be able to identify the Bitcoin.
Okay.
Yeah.
TradingView. Now, I am using TradingView from my system. Now, this was analysis I did last year. I carried chop ARB last year. Anyway, I am using TradingView from my system, right? And it is this thing is quite different from what you have on your phone. But when you get to your phone, maybe what I will do, let me do a screen record of TradingView on the phone, and I will send it to the group so you can use it to do your setup. That's what I will do. Okay. I will do it right now as I'm ending this class. Any other question?
Sorry, I have a question, but it's related to that TradingView, but it's not something you treated.
Okay.
In regards to the crypto aspect of that trading view, I noticed something. So I want to ask a question. If, for instance, now you want to analyze a chart on, let me say, that Bitcoin or Ethereum, anyone,
Mm.
they have the perpetual, they have the spot, but I notice a place where you see maybe trading view by Bit, trading view KuCoin, trading view Binance, and so on. So that aspect, I thought that aspect
Now,
is.
every exchange, if you notice, everything you see there are all centralized exchanges. You cannot see any decentralized exchange there. Every exchange have a difference in trading price. That is why arbitrage trading happens in crypto. Because arbitrage trading is just the difference between the trading price of Binance and Bybit. A coin can be trading on Binance at $0.5 and it is trading at $0.339 or $0.45. Now somebody will buy it at $0.45 on Bybit and come to Binance and sell at $0.5. That is arbitrage. Are you with me? So now,
Yeah,
each of those, if you're doing your analysis on the coin on Bybit, that is why it will show you whether it is Bybit because of the slight difference in price. There are some of them that will happen, the difference will be very obvious. Some of them will not be very obvious at a point in time. So that slight difference, that is why if you're analyzing a trade on Bybit, if you analyze on TradingView a Bybit trade, you have to trade it on Bybit. Remember that particular trade you are analyzing now, it may not, your entry may not be the same as of that of Binance. That is why I usually say it that I do not like buying signals because there are a lot of things that are considered before a signal is given. Now, somebody might do an analysis on a coin which is $0.5 on Binance, and on Bybit is $0.45. So where would you put your entry? You see, so it has actually nullified the trade, the signal, right? So if you're analyzing on Bybit spot, the price of Bybit spot and the price of Bybit perpetual are not the same. They may not be the same, may not, mark my words, may not. Doesn't mean that they cannot be. So, but when that difference occurs, that is where the arbitrage traders make their gain. So you need to put these things into consideration when doing your analysis. Does that answer your question?
Yeah, thank you. I understand better now.
All right. So any more questions? From the explanation I gave, did you guys understand these two signal candlesticks? By tomorrow, we'll
Yes, ma'am.
go into more. All right. Okay, in the absence of any more questions, go and focus on the assignment. Now you know you will do your assignment. Now you're seeing why I started with assignment from day one, because I know what you're going into. This is not, I told you, this is not a class for lazy people. It's not a class for excuse. You do more work here because calculation, see all those calculations you will run away from in school. You don't come and here. God bless you. So ensure to take your time, create your TradingView account, and then do this, find out this thing, and also go and read that book. If you need any explanation, you can read that book and find out those explanations, and then identify those things and forward it as your assignment before 3 p.m. tomorrow. If you don't have your assignment before 3 p.m. tomorrow, don't send it again to me. Thank you very much. And in the absence of any more questions, and I told you that you're supposed to complete your fee Let me pause the recording now.